Hey everybody, it's a Monday morning stock options podcast. Today we're going to talk in theory a lot more. So you don't even have to stare at the screen. You can hopefully just listen to me. Maybe you're driving, maybe you want someone to listen to. Well, I have a lot to say this morning. Whenever I get a rush of people contacting me about things, whenever like I start to talk about something and then a lot of people that have a lot of money. Also, I almost want to say that people I know that have money in life. I know that's a really broad statement, but sometimes I know people that do really, really well financially. And when they start asking me questions all the time and they get interested in what I'm doing, it, it gives me pause for a second because I'm thinking like, well, wait a minute, why haven't I been doing something like this all along? And I start to think about that. But let me back up. We're going to do a podcast about stock options and we're going to explain what stock options are because I started to look this up because I was trying to, I got asked the question like, Ken, what you're saying about stock options and some advice about how to place stock options in the market. What you're saying has shown some benefit and sounds really interesting. Why doesn't everyone else do it? Like, why am I only hearing about this from you? Like, why doesn't everyone else do this? And my answer to that so far has been stock options are a pretty complicated idea and they haven't been around forever. They started in 1973 apparently. Chicago Board of Exchange is the first exchange that theorized the stock option and I guess created a product out of it. You're going to have to double check me on that one, but that's what the information I got going with Google. That makes about sense. I don't remember hearing stories about stock options back in the Great Depression and the stock market crash in the late 2029 or whatever, 1929. I don't remember stock options necessarily being a part of that, but maybe they were, but let's assume that they weren't and that options have only been around since 1973. And on top of that, they didn't become popular until online trading started to become popular in the mid 90s, okay, 1990s. So we're talking about 30 years ish about stock options kind of being a thing. What are they? And why doesn't everyone do them? I've had to teach people how to do them and I still can't get people that I respect their intelligence and respect their ability to make money and the desire to make money. I can't get them to bite. Some people, whenever I sit down with a few people I know who like numbers, who are good with math, and I'm like, you should do stock options. They're like, nah, financial statements. I don't want to read everything. No, I can't. I don't want to handle it. It sounds too complicated, whatever. I can't get them to understand. Fine. I'm not going to try to convince people. I'm just going to write an algorithm that does it and then put the algorithm into play and explain why it's working and will continue to work. It can't not work. It can only, I mean, basically, you're looking for truth in numbers. You're not looking for, you're not trying to get subjective opinions on companies and whether or not they will go up and down. You are simply looking for deals in the marketplace where people are selling an idea and they are not valuing the idea they are selling correctly. And you have a tremendous amount of value buying what they are selling because they're going to owe you a bunch of money if what they think is not going to happen happens. Let me explain. All right. So, first thing you need to know about stock options is instead of paying face value for a company, we're going to use IBM as the example here. IBM right now, as I refresh on a different source, IBM is at $123.41 a share. Okay. I'm looking online. This is not going to be as correct when we look in this table. This table will be updated frequently, but I froze it as of this morning. It says 122.84. They're actually 123.41. They are 57 cents greater than this number right here. 57 cents. Now let's go back to this table for a second. What this table is doing here, this pivot table, is answering the question about, based on how these companies moved on Friday, last time they had a full day, they moved a certain amount of dollars per share. In IBM's case, IBM went up $1.94 per share. That's kind of more than normal for them. They are really, really reasonably priced when it comes to their options. So let's back up for a second and we'll talk about money at face value and money when it comes to options value. So I was saying, well, IBM right now is at $123.41. So let's say you have $123 or $125. So you got $125 you want to invest today in the stock market. Do you just buy a share of IBM and you'd already be up 57 cents if you bought one on Friday, because apparently they're up 57 cents pre-market here on Monday morning. Now, we're just talking in theory. Nobody's going to run around selling shares every time they change 57 cents, although you could. There's no fee for buying or selling a share, as there is a fee for writing an options contract, but there is not a fee for buying a share. So you could just, buy the share and sit back and wait. If you did that, this $123 or whatever that you paid for the share of IBM, maybe they go up like $5 at the end of the week, maybe on a good week for them. Maybe 10 in a crazy, crazy world where they go up $10 a share. That's not a lot of change in your investment for the week. That's maybe 5 or 10% max. Probably somewhere in the neighborhood of 2 to 10% in either direction is probably what will happen. Now, that's if you just buy a share of them, right? Well, that doesn't sound like you're going to become super rich buying your one share of IBM, right? You're not going to make a lot on your money or lose a lot on your money. It's going to be very, very close to what you put in there. So when trying to figure out if that's a good thing to do with your money, you have to ask yourself, well, what kind of risk tolerance do you have? What do you want to try to do with this money you're investing? Do you want to sit back and not worry about it too much and not get too emotional? Well, this video is not for you then. So that's not what I want to do with my money. I think time is absolutely money, and I want to make as much money in as small amount of time as possible within reason. And so I use options instead of buying shares. And what do options do? For example, what can you do with your $123 if instead you buy options? Well, for the sake of example one, we will assume that we think IBM is going to go up. Let's put on our thinking cap about what might happen with a company today. They are not allergic to the word AI. They built the thing Watson that beat everybody on Jeopardy years ago. Like, that's almost a form of a language model, but it's certainly a form of aggregating information and spitting out a result, even if it's not really a language model. I don't know what kind of neural network Watson has or how that works, but certainly training on information. They're like I said, they're not allergic to the word AI. They were talking about dumping a bunch of employees and maybe replacing them with robots. They are at least trying to make some news. Now, when you buy options, the one sentence description or phrase about how you compare an option to buying not a share, but an option, comparing the way you buy options and what they do compared to just buying shares is they move 100 times as fast. They move at 100x for the most part, meaning if the company goes up $1, then the option goes up $100 if you bought a call option. Because call options are assuming you buy a call option when you want the company to go up, and every time they go up a penny, if you are in the money, meaning if your option is at a price where the company is already above that price, that's what a strike price is. Every time they go up a penny, your option intrinsically goes up $1, goes up 100x. So if you had $125 and you wanted to put it on IBM, as of right now, even though the market is not open for options trading, the market opens at 9:30 a.m. and closes at 4 p.m. East Coast time. When it comes to buying and purchasing options, you cannot buy and sell them after hours. There's no available market for them. But as of Friday at 4 p.m., you could buy a $123 call option for 94 bucks. My favorite number. It's funny. That is my favorite number. It's 94. It's my hockey number. You can buy a call option for $94 at a $23 strike price. Now you can't because the market's not open right now. And when the market does open, if IBM is up this 0.5%, it's going to cost a little bit more than $94 to buy that option. It will probably cost, it has to cost at least the intrinsic number of whatever they are minus 123. It has to cost at least that. Because if it didn't cost at least that, then you should dump all your money into buying one and then immediately selling it because you'd be guaranteeing yourself the difference. Let me explain. So they're actually at 123.48. They're now up 64 cents. So they're 123.48, right? They were 122.84 at the end of Friday. They're now pre-market 123.48. So you have to pay at least $48 for this option that I'm pointing at right now, this strike price option. When we look, the reason why is you get 100 shares of IBM that you are buying at $123. That's what a strike price means. You're not actually paying, $1,230. Sorry. Yeah, that's right. Yeah. Oh, no, sorry, 12,300. That's what it would actually cost to buy 100 shares, right? Yeah, $12,300 is what it would cost to buy 100. You don't have to do that. And you only have 123 bucks here. You don't have to do that. But you're getting the impact because they are up 48 cents above this, you could turn around and sell all those 100 shares on the market for 12,348. So if you're allowed to buy them at 12,300, there's $48 that you just made because you can sell them for this and you bought them for 12,300. So the option, like I said, multiplies the change in value of the stock by 100, which is making like your stock changes 100 times more. So why not buy options? I'll tell you why you don't buy options sometimes. Because they have an expiration date and they expire at a certain date. And then you have to make movement on them before then, meaning you have to sell the options contract or you have to exercise the option and buy the 100 shares. You have to do one of those two things. Well, for the purposes of what I'm asking the AI to do and what I'm searching for is we're assuming we're never going to exercise any of these options, meaning we're never going to buy 100 shares. Meaning you don't need $12,300. You only need 123. And then at some point before the option expires, we're going to sell it, hopefully for more than we bought it for. And sometimes for a lot more than we bought it for. And sometimes for a lot less than we bought it for. It's going to go both ways, which is why I say don't just buy a call option on IBM for $94 today, but also buy a put option, which is an option saying that they are going to go down as well. Oop, come on, we'll find IBM. When I queried the prices of what these options cost, IBM's was $94 for the call and $99 for the put. That's how we end up with everything costing 193 bucks. Let's round it up to 200, just to assume there's some movement in prices and maybe we don't get the options for this cheap. Let's call it 200 bucks. Do you know all that has to happen between now and Friday? Because the option I'm talking about expires Friday, May 19th. That's a week. Do you know what has to happen? IBM simply has to move more than 2%. That's all they have to do. Pre-market on Monday, before the day has even started, they are now, they're up 0.52%. They're up 0.5%. They just have to go 1.5% more up or 2.5% down. And what happens then? Explain to you what happens if they do that. Because that's what these numbers mean right here. There's a break-even percentage, there's a cost of the contract, and there's also how much they moved the last day. They actually moved as much as they needed to move. This is $1 more than this, basically. Well, what I'm talking about is the option, the call option. Let's say that they go up. Let's say that they go up 2%. And all of a sudden, instead of being this price of 122.84, they go up 2%. They go up like $2.50 or something. They get to 125, let's call it. That'll actually get them there, I think. 125 probably gets them there. If they get to 125, let me show you what happens. If they get to 125, you have a call option at 123 strike price. And now they're at 125. So 125 minus 123 is $2. That means that if you exercise those 100 options, if you exercise those 100 options that we were talking about, you can sell them on the open market at 125, and you paid $12,300 for them. They're now worth $12,500 now. So that's $200 difference. And guess how much you paid for the options? Hopefully less than $200. And you're up the difference. So the option ends up changing value, meaning this 94 all of a sudden becomes 294. And this 99 becomes like 35 because nobody thinks they're going to go down. So now all of a sudden you have two options that are worth $329 instead of what you paid for them of 193. And you can just get out of those contracts and you can take profit. All right. That's what we're doing here. Why doesn't everyone do this? Why doesn't everyone just play off volatility of the market? Because that it took me minutes to explain. And usually when I'm trying to explain a simple algebraic equation about like, hey, guess what? Buy something for this amount, sell it for this amount, should be an easy video. No, but it's complicated. You're right. There's a lot of things to think about because there's calls and there's puts and there's massive fluctuations in value. Well, I focus on IBM for this video because look how cheap they are at under $200. We could do this with First Solar, where we're going to have to come up with $1,500 for a 1 week option. That's really expensive in my mind for a 1 week option. It's $300 a day worth of action on one company that just went up $48 and they have to move 6.6% this week. That's still a pretty big number. That's why I'm hesitant to advise doing this. It's expensive and it's risky. This is not risky. The chance that IBM moves more than 2% at some point this week is really good. I don't know what percentage chance that is. I would like to know. I guess you could go back and make some historical, you could do some historical calculations on how much they've moved in every 5-day period and come up with an answer. I'm just going to guess because I don't know the answer. So I apologize for not knowing the answer, but I'm going to guess that they move more than 2% in a week 75% of the time. I'll just make a random guess. I don't know the answer to that. I should know. I apologize for not knowing. But I'm going to guess that, and we'll see if my guess is right. That would mean 3 out of every 4 times you buy this option, you're absolutely going to make money. That's what that would be. If they move more than 2% from their original price at the beginning of the week, 80% or 90% of the times over the last, out of the last 45 weeks, did they do that 40 times or something? I don't know. I don't know the answer to that. We should check. But here's what I do know. I do know that it's only 2% that they have to move. And so let's look at all companies for a second by ascending cost of options. Because these are the cheapest. Look at that. They are number one. They are the cheapest one of all the companies I've done so far, which is not the full market. I have not finished. Sorry, I haven't. I've only done 400 of them. I have a lot to do. I'm only down here having, I only have information all the way down to the top 400 highest price companies. Is basically all I got in here. I have a ton of work to do. Look how much work I have to do all these. I'm going to start working on them today. There's like 1,500 more I have to do. So of the first 400, IBM is the cheapest. Then this Atmos Energy Corporation, which I don't know about. This is probably also a good one. Kimberly-Clark, don't know much about it. But this is how much they moved on Friday, and this is just cheap, 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 which means any of these companies have big days where they move even like 4 or 5%. If they move 4%, any of these companies move 4% today, right? Like all the way up to here where it costs you $300. That's Google too, by the way. Look at that. Any of these companies move 3% today. You have no choice but to sell it and make 50% on your money or more. If they're 25% on your money or more, actually. It's a complicated answer because you'd have to run the numbers. But just understand that these being super cheap means that at least when it comes to cost and potential movement, this is excellent value. And I never would have known this had I not gone through all their options prices, which is a dynamic negotiated number. You are buying a contract that someone else is selling. Someone else thinks that IBM is not going to move very much this week. That's why they're selling you a call or a put option on them. And that's because they're looking at the history of IBM and they're like, yeah, they don't move that much. But clearly there's value here because you can see how much lower it is than all the other ones. That's all that's happening here. So I'm going to be gathering information. Pepsi, also a pretty good one. You can see they're almost $200 a share. This is another good one. I'm looking at where the break-even number is also lowest. Let's do it by break-even number for a second. Sending break-even percentage. This means that these companies have to move the least for us to make money. Procter & Gamble, McDonald's is just the cost of McDonald's options is a little more because they're also up around $300 a share. You see that Pepsi, for example, is about the same amount as McDonald's in terms of share price. All right, I'll find you Pepsi in a second because I think they're, yeah, they're number 7. That's not bad. They're right here, right? These two. The reason I bring up these two is look at their strike prices. They are higher price shares, meaning they can potentially move more dollars. They have more dollars. Oh, sorry, Pepsi's only 200. McDonald's is 300 almost. Yeah, McDonald's is another good one. This break-even number, this matters. So the algorithm this morning here, the AI that I've created says this in order, but it also says things like, yeah, it says McDonald's, it says Pepsi, it says Hershey's too. I don't know this waste management company, so I don't want to recommend it. I don't know about Procter. For some reason, I'm shying away from Procter & Gamble. I shouldn't. It's on the list for a reason. Just look at the list. Don't listen to me. IBM is right here, but IBM is also number 1 on this list. So absolutely. So I'll just back up and recommend IBM's call and put stock options for this week. We are 2.5 hours away from the open of the market. We'll start with there and we'll go over what happens with IBM. And then the end of the day video tonight or into tomorrow, we'll discuss the new look as I bring in everything that has changed for the day and refresh this. And it's going to be really time consuming to update the new options amounts. So we're going to kind of do them on a 1-by-1 basis when I talk about them in the videos, because there is not currently a way to automate the cost of the strike and the cost of the call. And that is because it is fluctuating too much that all there is a bid and ask price. And I had to estimate these numbers. So I did a discussion in the previous video about whether or not the type of the spread range of the option, meaning how sure are we that this is the cost of the options? It relates to companies that have tight spreads. So like these companies, I'm very confident that this is a very close approximation of what the option would have cost on Friday at the close. So it's much more reliable, and you want tight spreads because that means that you have a better idea of what the option costs and what you can sell it for. Things with loose spreads, you do not know. You do not know as much because the range is so huge. Something like MicroStrategy, the range is still big and the number is huge. So the algorithm does not really recommend doing call and puts on MicroStrategy because it says it's a super risky enterprise that's very expensive and that you don't have a good idea how much it costs. All those things make it difficult to do this strategy with a company like MicroStrategy. Makes it a lot better to do it with a company like this. I don't want to guarantee things, even though I guaranteed, I made a guarantee in last week's video and Zscaler did make money. I want to guarantee IBM will make money doing the strategy this week. I guess I can't legally guarantee that because I guess they could potentially not move 2% this week. That totally could happen. And you'd be left with less than your $200 or 193 that you invested, depending on where they close at the end of Friday. But you're not going to lose the entire amount. No way. You're always going to be able to sell those options before their expiration date for some monetary value, whether it be as low as $1 or as high as infinity. You will be able to sell them for something. So I guarantee you will not lose 100% of your investment if you sell it before the expiration date. That I can guarantee. As long as they don't like halt trading on the company or something, I think that might be a potential way you could lose, but I don't know that for sure. But anyway, point is, I guarantee something will happen. And I want to say that there's a really good chance you make money on this. Perhaps it is the least expensive way with the companies that I've analyzed. It's the least expensive one to invest in. So we're absolutely trying it because it's number one on the cheapest list and it's got a very low break-even number. All right. So good luck, everyone. Maybe IBM will move 2% today, and I will show you how it is actually profitable in one day, even though it only we have till Friday, but it could do it today. And the chance they do it today, if they had a day like Friday, they do it today. They actually do change to 100% in alteration here, which is what this number means. So it'll be fascinating to watch. All right. Good luck, everybody. May IBM be moving around more than normal today, because then we will all win.